There is a ticking time bomb sitting underneath the price of Bitcoin. It is not the halving. It is not the Federal Reserve's interest rate policy. It is not even the regulation of exchanges like Binance or Coinbase. Those are the risks that everyone can see. Those are the risks that are already priced into the market. The real danger, the one that almost nobody is talking about, 'tis boring. It is technical. It is buried deep inside the pages of a new regulatory handbook that is scheduled to take full effect in 2025. It is an accounting rule change. It sounds harmless. How can a change in the way accountants write down numbers in a ledger possibly crash an asset class worth over $1 trillion? The answer lies in the link between the corporate stock market and the crypto market. For the last 4 years, we have cheered as massive public companies have started adding Bitcoin to their balance sheets. We celebrated when Tesla bought $1.5 billion worth. We celebrated when Block and PayPal entered the space. And we have watched in awe as MicroStrategy turned itself into a leveraged Bitcoin holding company, accumulating more Bitcoin than any sovereign nation on earth. We viewed this corporate adoption as a safety net. We believed that these companies had diamond hands. We believed that because they were public corporations, they would never panic sell like a retail trader. But we were wrong. The new rule, known as FASB, or FASB ASU 2023-08, changes the physics of corporate holding. It transforms Bitcoin from a passive asset on a balance sheet into an active driver of corporate profits and losses. It effectively imports the wild volatility of crypto directly into the quarterly earnings reports of the S&P 500 companies. And in a downturn, this rule creates a mechanism for a doom loop, a self-reinforcing spiral, where a drop in Bitcoin's price forces companies to report massive losses, which crashes their stock price, which triggers debt covenants, which forces them to sell Bitcoin, which drops the price of Bitcoin even further. This is the story of the hidden accounting trap that is waiting for us in 2025. This is the story of how the greatest strength of the current Bitcoin cycle corporate adoption could become its greatest weakness. To understand this threat, we have to start with the basics of how companies report their wealth. In the United States, public companies must follow a strict set of rules called Generally Accepted Accounting Principles, or GAAP. These rules are set by a private board called the Financial Accounting Standards Board, or FASB. For years, Bitcoin occupied a strange gray area in these rules. It was classified as an indefinite-lived, intangible asset. This is the same category used for things like trademarks or goodwill. Under the old rules, which are still in effect for many companies until 2025, the treatment of Bitcoin was very one-sided. If you bought Bitcoin for $50,000 and the price went up to $100,000, you were not allowed to report that gain. You could not show that profit on your balance sheet unless you actually sold the Bitcoin. However, if the price dropped to $20,000, you were forced to report an impairment loss. You had to write down the value of the asset immediately, and that loss hit your earnings report. This was annoying for companies, but it was actually a safety mechanism, because they could not report the gains. Their stock price was not entirely dependent on the quarter-to-quarter fluctuation of Bitcoin's price. Investors knew the accounting was conservative. It kept the volatility somewhat contained. But the crypto industry hated this rule. They lobbied hard for a change. They argued that it was unfair to only report losses and never report gains. They wanted fair value accounting. Fair value accounting means that at the end of every single quarter, every 3 months, a company must look at the market price of Bitcoin and adjust their books to match it exactly. If Bitcoin goes up, they report a profit. If Bitcoin goes down, they report a loss. The FASB listened. They passed the new rule, ASU 2023-08. It becomes mandatory for all fiscal years, beginning after December 15, 2024. That means throughout 2025, every major public company holding Bitcoin will be playing by these new rules. This sounds like a victory. Finally, companies can show the true value of their holdings. But be careful what you wish for. By adopting fair value accounting, these companies are removing the firewall between the crypto market and the stock market. Imagine a scenario in 2025. Let us say we are in a standard crypto correction. Bitcoin drops by 20% in a single quarter. Under the old rules, companies might have taken a one-time impairment charge, but investors largely ignored it because they knew it was just a paper loss. Under the new rules, that 20% drop flows directly into net income. A company that is fundamentally healthy selling software, or cars, or payment services could suddenly report a massive net loss for the quarter, solely because the price of Bitcoin dipped on September 30th. Stock market algorithms do not like volatility. They do not like net losses. When the earnings report comes out and shows a massive red number, the algorithms sell the stock. This creates a direct correlation. When Bitcoin falls, the company's stock falls. Now, you might ask, why is that a catastrophic risk? Companies see their stock prices go up and down all the time. Why would a bad earnings report force them to sell their Bitcoin? The answer is debt. This brings us to the elephant in the room: MicroStrategy. MicroStrategy is no longer just a software company. It is a leveraged hedge fund disguised as a technology firm. Under the leadership of Michael Saylor, they have accumulated a staggering amount of Bitcoin. As of our hypothetical scenario, in late 2025, let us assume they hold roughly 650,000 Bitcoin. That is more than 3% of the entire supply of Bitcoin that will ever exist. They did not buy this Bitcoin with cash flow from selling software. They bought it with debt. Specifically, they used convertible senior notes. A convertible note is a loan. Investors lend MicroStrategy money, and in return, they get the option to either be paid back in cash or to convert that debt into MicroStrategy stock at a specific price. This strategy works brilliantly when the price of Bitcoin is going up. Bitcoin rises, MicroStrategy stock rises. The lenders convert their debt to stock, and everyone gets rich. It is a money printer, but leverage cuts both ways. Let us look at the nightmare scenario that the new accounting rule enables. It is the fourth quarter of 2025. The crypto market is overheating. Maybe the regulatory environment has turned hostile. Maybe there's a macroeconomic recession. Bitcoin prices start to slide. Let us say Bitcoin drops from $80,000 down to $60,000. A 25% drop. In the volatile world of crypto, this is a normal Tuesday. But for MicroStrategy holding 650,000 Bitcoin, a $20,000 drop per coin equals a paper loss of $13 billion. Under the new FASB rules, MicroStrategy has to report that $13 billion loss on their quarterly income statement. To put that in perspective, MicroStrategy's core software business generates maybe $100 million in operating income a year. So, the headline on Bloomberg and CNBC reads, MicroStrategy reports $13 billion quarterly loss. This number is terrifying to traditional stock investors. The algorithms react instantly. MicroStrategy's stock price crashes. This is where the danger lies. The stock price is the collateral for the debt strategy. If the stock price falls too low, the convertible part of the convertible bonds becomes worthless. The lenders will not want to convert their debt into stock that is crashing. They will want their money back. They will want cash. MicroStrategy has billions of dollars in debt maturing in the coming years. If the stock price is high, they can roll over that debt or convert it to equity. If the stock price is crushed by these massive FASB-reported losses, the capital markets might close their doors. Suddenly, Michael Saylor faces a liquidity crisis. He owes billions of dollars to bondholders. He cannot issue new stock to pay them because the stock price is in the tank. He cannot borrow more money because his earnings report shows a $13 billion loss. He has only one option left to pay the bills. He has to sell the assets. He has to sell the Bitcoin. This is the trigger event. The moment the market realizes that MicroStrategy might be forced to sell, the predatory trading begins. Hedge funds and short sellers will smell blood in the water. They will short Bitcoin aggressively, trying to drive the price down further to force MicroStrategy's hand. If MicroStrategy has to liquidate even 10% of its holding 65,000 Bitcoin, it would unleash a tsunami of selling pressure that the market cannot absorb. The price of Bitcoin crashes further. And because the price crashes further, the next quarter's FASB accounting report looks even worse. The losses get bigger. The stock falls further. The need to sell more Bitcoin increases. This is the definition of a death spiral. It is the exact same mechanic that destroyed the Terra Luna ecosystem. But this time, it is happening on the Nasdaq, involving regulated public companies and institutional bondholders. But MicroStrategy is just the first domino. Consider the psychological impact on other corporate treasurers. Imagine you are the chief financial officer of a large S&P 500 company. You have been watching Bitcoin. You have seen the ETFs. You are thinking about allocating 1% of your treasury to Bitcoin just to protect against inflation. Then you see what happens to MicroStrategy. You see how the FASB rule forced them to report massive volatility. You see their stock price getting hammered. You look at your own job security. You realize that if you buy Bitcoin and it drops 10%, you have to report a loss that will ruin your quarterly bonus and maybe get you fired. You decide not to buy. In fact, companies that already hold Bitcoin like Tesla or Block might look at this volatility risk and decide to exit. They might say, "We believe in crypto, but we cannot afford to have these wild swings on our income statement." So, instead of corporate adoption accelerating in 2025, we could see a mass corporate exodus, a de-adoption event. We also have to consider the tax implications. The end of the year is always a dangerous time for crypto markets due to tax loss harvesting. Investors sell their losing positions in December to offset their gains for tax purposes. Now, imagine the FASB rule comes into effect right as we approach the end of 2025. The market is already weak. Retail investors are selling for tax reasons. Then, the news breaks that MicroStrategy is facing a margin call on its debt or is being forced to restructure. The selling pressure from tax harvesting combines with the panic selling from the MicroStrategy rumors. Liquidity dries up. The order books on Coinbase and Binance become thin. A flash crash occurs. Bitcoin drops 30, 40, or 50% in a matter of days. And unlike previous crashes, there is no corporate savior waiting to buy the dip. Because the corporate saviors are the ones being forced to sell. We must also look at the regulatory angle. The Securities and Exchange Commission, the SEC, has always been skeptical of crypto. They have approved the ETFs, but they have not embraced the asset class. If a public company like MicroStrategy blows up because of its Bitcoin exposure, it's causing massive losses for retail stock investors. The SEC will step in with a vengeance. They could pass new rules limiting the amount of digital assets a public company is allowed to hold relative to its capitalization. They could force companies to divest their holdings. This would turn a market crash into a forced liquidation event mandated by the government. Furthermore, index providers like MSCI or S&P Dow Jones might remove companies with high Bitcoin exposure from their indices. If MicroStrategy gets kicked out of a major stock index because its earnings volatility is too high under the new FASB rules, all the passive index funds, the Vanguards and BlackRocks, of the world would be forced to sell MicroStrategy stock instantly. This would crush the stock price even further, accelerating the doom loop we discussed earlier. It is important to clarify that Michael Saylor has stated repeatedly that he will never sell. He has structured his debt carefully. He has diamond hands. But history is littered with the corpses of financial titans who said they would never sell. The Hunt brothers said they would never sell their silver. They were forced to. Long-term capital management said their arbitrage strategy was risk-free. They were forced to liquidate. Three Arrows Capital said they were in it for the long term. They went to zero. In financial markets, never is a word that lasts only as long as your solvency. When the bondholders come knocking and the covenants are triggered, your ideology does not matter. Only your liquidity matters. So, What does this mean for you, the individual Bitcoin holder? Does this mean you should sell everything now? No. The FASB rule change is a double-edged sword. We have focused on the risk, but there is also an upside. If Bitcoin goes to $150,000 or $200,000 in 2025, companies will report massive profits. MicroStrategy will report billions in earnings. Their stock will go parabolic. This could trigger a FOMO frenzy, where every company rushes to buy Bitcoin to boost their earnings per share. The FASB rule acts as a volatility amplifier. It makes the pumps higher and the dumps lower. However, as a risk-conscious investor, you must understand that the floor price of Bitcoin has become more fragile. In previous cycles, we assumed that if Bitcoin dropped to $30,000 or $20,000, Michael Saylor would be there to buy more. In the next cycle, if Bitcoin drops to those levels, Michael Saylor might be the one selling. This changes the game theory of the market. It means that the support levels we rely on might not be real support, might be leverage liquidation points. You need to watch the debt maturity dates of major Bitcoin holders. You need to watch the premium or discount of MicroStrategy stock relative to its Bitcoin holdings. If you see MicroStrategy stock trading at a massive discount to the value of the Bitcoin it holds, that is the market telling you that it expects a forced liquidation. That is the canary in the coal mine. You also need to pay attention to the earnings calendars. In 2025, the dates when MicroStrategy, Tesla, and Block release their quarterly earnings will become major volatility events for the crypto market. Traders will try to front-run these reports. If Bitcoin is down for the quarter, traders will short the stock and the coin before the report comes out, anticipating the bad news. This creates a new calendar of risk that did not exist before. We are entering a period of financialization of Bitcoin. It is no longer just a digital rock that you keep in a cold wallet. It is now a line item on a corporate balance sheet, subject to the whims of accountants, auditors, and bond traders. This brings legitimacy, yes. But it also brings systemic risk. The crash of 1929 was not caused by the companies going out of business. It was caused by leverage and margin calls. The crash of 2008 was not caused by the houses disappearing. It was caused by the leverage attached to the houses. The potential crash of 2025 will not be caused by Bitcoin failing. The Bitcoin network will keep producing blocks every 10 minutes. The protocol is secure. The crash will be caused by the leverage attached to the Bitcoin. The FASB accounting rule is the mechanism that exposes this leverage. It is the light switch that, when turned on, might reveal that the room is full of explosives. So, how do you prepare? First, do not leverage yourself. If the whales are leveraged and facing a potential squeeze, you do not want to be in the same boat as them. If the market crashes 50% because of a MicroStrategy liquidation, you want to be the one with cash ready to buy the wreckage, not the one getting a margin call. Second, understand that the correlation between stocks and crypto is going to get tighter, not looser. The narrative of uncorrelated assets is dead for now. As long as public companies hold the asset will move with the stock market. Third, keep an eye on the corporate bond markets. You see the yields on MicroStrategy. debt spiking, meaning the bonds are trading at 60 or 50 cents on the dollar. That is the bond market screaming that a default is coming. The bond market is usually smarter than the stock market, and definitely smarter than crypto Twitter. We are heading into uncharted waters. The FASB rule, FASB ASU 2023-08, is a dry, boring piece of regulation. But it has the potential to be the spark that ignites the biggest deleveraging event in crypto history. Most people are only looking at the chart. You need to be looking at the ledger. The market is efficient at pricing in known risks. It is terrible at pricing in structural shifts in market plumbing. This accounting change is a plumbing shift. The pipes are being rerouted. And if the pressure gets too high, the pipes will burst. If this deep dive into the hidden risks of the market was valuable to you, you need to subscribe to this channel. We do not just tell you Bitcoin to the moon. We look at the mechanics, the laws, and the money flows that actually determine price. In our next video, we are going to investigate the miner capitulation signal. We have new data showing that major mining companies are dangerously close to their break-even price. And if the FASB crisis hits, the miners could be the second wave of forced sellers that sends us into a multi-year winter. You need to see the numbers to believe it. The game is changing. The rules are changing. Make sure you are ready.